So let's get started on your cash flow and balance sheets. I'm going to start with the cash flow. And to make it really simple, I'm going to explain how that basically gets calculated. So you have to determine how much money is coming in, how much is spent, and then how much is left over. So beginning cash balance would mean any bank account that you're starting out with. Let's just say you have $20,000 in a bank account to start your business. That would be considered your beginning cash balance. Cash from operations, that's sales, technically. Any sales would be considered a cash from operating activities. Cash from investment received, once your investor has given you a check to invest into your establishment, that would be considered the investment received. And then you subtract cash from investing activities, which is any spending. That could be operational expenses, payroll, real estate acquisition, anything that you're spending that money on is an investing activity. And then that would equal your ending cash balance. So that's what basically a cash flow sheet is. Balance sheet, there are three major categories. There are assets, liabilities, and owner's equity. So current assets would be such things as checking accounts, money in transit, accounts receivable, short-term investments, inventory, prepaid expenses, and cash equivalents such as currency, stocks, and bonds. Now there are also long-term assets, and that long-term assets would be building and land. If you bought a property, if you bought the building that you're going to be running your dispensary out of, that would be considered a long-term asset. Machinery and equipment, anything of that nature that would last for long periods of time. Now, intangible assets are also a long-term asset. And let's just say that you have secured branding for your company. Patents or trademarks, anything like that, that's considered an intangible asset and a long-term asset. Long-term investments of any sort would be a long-term asset. So current liabilities would include accounts payable, like monthly bills, wages to employees because they've already done the work for you, therefore you already owe them those salaries, short-term loans, and any taxes owed. Long-term liabilities are loans that are not paid back within a year. Maybe you have a 5-year loan on a vehicle, or another long-term loan that lasts. Anything that lasts over a year is considered a long-term liability. And bonds your company has issued to other parties would fall into this category. Now, owner equity is any capital that was invested in the company, any stocks, and retained earnings. Balance sheet is basically liabilities, which anything owed, plus owner's equity equals your assets. So let's go over the task list for this section. You calculate your cash flow to find out how much cash you will have on hand after everything is said and done. And your balance sheet basically shows the prospective investor what your projected company's worth is. So let's move on to the final section, and good work.